Okay, thank you so much for joining us today. Good afternoon or good evening to some of you. I am Chad Robbins. We are lucky enough today to be joined by the 2023 World Cup Trading Championships first place winner, Ivan Scherman. Ivan's going to be giving us a short presentation today, going over what he did last year, what his strategy was, and how he deploys it. And then I'll cover what we do at World Cup Advisor and what your opportunity is if you'd like to follow along with Ivan's trading. If you do have questions along the way, please feel free to click on that question box and submit your questions. If it's appropriate and we're able to answer them during today's presentation, we will. If not, we'll try to hold off towards the end to address those questions. Without further ado, Ivan, are you there, sir?
Yes, I am. Good afternoon, Chad.
Thanks for joining us, Ivan. If you could go ahead and share your file.
There we go. All right. Thank you all for being here. My name is Ivan Scherman. I will be sharing the process I followed to win the World Cup Championship last year, and so you guys can understand my investment approach, my focus on risk management. So here we go. Okay. The purpose of this presentation is to show you guys a strategy behind the result I got from the 2023 World Cup Championship and how it can be replicated and sustained in the long term. This methodology is not recommended or intended to meet the needs of all individuals, given its level of risk and the recommended time horizon. The key points I'm going to expose about are the results I achieved in 2023, the replicability and sustainability of the results over time, and my special focus on risk management, portfolio management, and the long-term perspective that my portfolio has. This is a comparative benchmarking my trading with the S&P 500. I don't know if you guys know, but I didn't trade the whole year, but I trade almost around 11 months. I started to trade in February, precisely on February the 6th. So the performance that I got in 2023 doesn't comprehend the whole year, but 11 months. That's why we are comparing my performance against the S&P 500 in that period of time. That's why it doesn't comprehend the whole year. As you can see, it would be 24% if we were talking about the whole year, but it refers to 16%, which was the performance of the S&P 500 since I started to trade till the end of 2023. Okay. What I try to achieve along the whole championship, of course, is a good performance, but the most important thing I considered in order to achieve my goals during the championship was to achieve consistency. Okay? What I wanted to show was not only a good performance, but a consistent equity curve. And to achieve that equity curve, a smooth equity curve with the less possible volatility, I had to focus in risk management. I had to get good returns without a lot of deviation. So my focus during the 2023 championship was on the risk management side, okay? And to achieve this risk management control, I use different strategies in order to minimize risk. And this includes diversifications in assets and markets, a stop loss in every single position I was trading, long short positions, the correlation between the P&Ls of every system I was trading, an equivalent risk distribution among assets and among systems as well, and market agnosticism. Okay, I'm going to explain each of them during the presentation so you can understand each of them in more detail, more deeply. So my risk management ethos is characterized by meticulous diversification, covering a broad array of strategies and assets. This approach underpins our capacity to operate multiple diverse strategies concurrently with the impact of diversification mathematically calculated and anticipated. The diversification includes assets and markets trying to avoid systematic risk, okay? So the diversification in assets and markets reduces risk by spreading investment across different assets and markets. You reduce the impact of any single investment's poor performance. At the same time, we get stability. Different assets and markets react differently to economic events, providing stability to the portfolio as a whole. And the potential for improved return is achieved by this approach because the diversification can help capture gains from different sectors and asset classes as market conditions change. That's why diversification in assets and markets was one of the topics to cover in this risk management approach. The next one is asset stop loss. Each asset included in the portfolio has a stop loss point established in advance based on the historical behavior of its pattern. The order will be executed automatically when the pre-established conditions are met, limiting losses without intervention of human psychology. And by using stop losses in each of the systems, a stop loss order automatically sells an asset when it reaches a certain price, limiting potential losses. And by doing so, we have a risk control measure, so the investor can set their maximum loss tolerance, providing better control over their risk exposure. And we have the point of emotional discipline, where it helps to avoid emotional decisions. Selling is automatic based on predetermined criteria. So by assets stop losses, what we can control is not only the risk involved in each of the systems, but the influence of human behavior in the trading methodology. The next risk management measure is the using of long and short positions. My strategy maximizes the advantages of long-short trading in the following ways. First, it multiplies the opportunities in the market. If I can go long and I can go short different markets, I have more opportunities to be exposed to. Second, the profits or losses do not depend on the market trend. In certain moments, I can get profit from a trend, and at the same time, I can get profits from the opposite swings of those trends. the mean reverting swings of that very trend. And the third point is that it allows me to hedge positions temporarily, okay? And this gives me market neutrality because by holding both long and short positions, my strategy seeks to profit from both rising and falling markets, of course. The hedging part, because short positions can serve as a hedge against downturns in the market, offsetting losses in the long positions, and the opposite, long positions can serve as a hedge against rising in the market we're trading, if we are shorting, of course, offsetting the losses in the short positions. And diverse investment strategies, because it enables to explode a ratio of investment strategy, not just those betting on market increases. And the fourth point of risk management, the fourth measure of risk management is the correlation. Each of the assets traded has a zero correlation level with the market based on the historical behavior of both. At the same time, each of the assets included in the portfolio has the minimum possible level of correlation with the other asset included. And I would say not only with the other assets included, but with the rest of the systems that are included in the portfolio. The equivalent risk distribution among assets allows me to have a balanced exposure. It ensures that no single investment or type of investment can disproportionately affect the portfolio. It allows me to have a risk optimizations because it helps in allocating capital to different assets in a way that optimizes the risk-reward ratio. And it allows me to have an efficient capital utilization because the capital is not over-concentrated in any one area, potentially leading to more efficient use of capital, okay? The sixth point in risk management was equivalent risk distribution. The risk distribution strategy includes equalizing the relative risk weight of each asset in the portfolio. What we wanted is to have, I wouldn't say a perfect equivalent weight of each system in the portfolio risk distribution, but something very similar. Getting something perfect is not possible, but we can get something similar in order to avoid that one of the systems concentrates the whole risk of the portfolio. In this way, not only do I prevent any one asset from taking all the risk in my portfolio, but I also reduce volatility, making the capital curve smoother and stronger, okay? And it gives me the possibility to avoid, for example, if we experience a crash during in one of my positions, if for example we have an open position in the S&P 500 and we experience, let's say, a Black Monday, if my risk is equally distributed among all the positions in the portfolio, that crash in one of my system wouldn't take the whole portfolio risk. That would reduce the volatility of the portfolio, and that would stop me from destroying my account just because of one position, okay? Another risk management measure was the market agnosticism. The market agnosticism looks for have a portfolio that seeks to remain market agnostic with all risk management tools. The portfolio can even remain liquid if conditions are not right to trade one or more assets. Let's remember that my trading methodology is a very active trading. So it will look for patterns, and those patterns are going to be translated into conditions that are going to be, they're going to have, those conditions are going to have to be met in order to open a position. Okay, this opens the possibility to generating generating profit, even in the context of market downturns, because if the conditions our system are looking for are too short, and those conditions are met, our systems are going to open short positions, considering that those conditions were generated. Okay. Overall, the risk management approach we have is centered around the idea of not putting all one's eggs in one basket, okay, and be prepared for a variety of market conditions. It's a holistic strategy that emphasizes balance, risk control, and minimizing the impact of any single event or trend on the overall portfolio. Okay. Now, moving to demonstrating how effective has been my risk management approach, you can see in this slide that even achieving a 491% performance, we experienced just a drawdown of 26.17%. This drawdown took only 2 months. It lasted only 2 months, and the recovery time was just 1 month. Okay, here you have the start date of the drawdown and the end date of the drawdown. So it was a very small drawdown considering the performance I had. Of course, we can assure what drawdown we're going to have in the future, but this is a sample of how it worked in the past. Let's remember that the performance of the past cannot be replicated in the future, of course. But here you have a sample of how my portfolio behaved in the past. Okay. Another thing that my portfolio looks for is accuracy in directionality. Okay. Accuracy in directionality translates in efficiency, because automatic trading systems can process vast amounts of data and execute trades much faster than humans, of course. They are pre-programmed with specific rules for trade entries and exits, which allows them to trade continuously without the need for constant human supervision. You can translate that into more opportunities, because you can trade to every single day while the market is open, every single asset that is going to be traded 24 hours a day. It translates into consistency, because they follow predetermined rules, because these systems can maintain trading discipline even in volatile markets. For example, if we are facing a volatile market and the conditions to enter a trade are met, we are going to open the trade, even having a volatile market, which could stop someone from opening a trade manually. If we are exposed to fear, we're going to try to avoid a trade. But if the conditions are pre-programmed and those conditions are met and the system opens a trade automatically, there is no fear involved. There is no psychology involved. Okay. So the third point would be elimination of emotional trading. Automating the trading process reduces the chances of emotional trading decisions that can lead to inconsistent trading results. This is something that I wanna avoid, and that's one of the reasons I trade automatically, okay? Then, as you can see, description of recognizing and analyzing recurring asset behavior patterns. What I look for is to have pattern recognition. The algorithmic trading approach, the algorithmic trading systems that I use are designed to recognize and analyze patterns in asset price movement that might be indicative of future price action. If I know that, let's give you guys an example. If I know that the S&P 500 closes 3 days in a row negatively, that means the price of today is less than the price of yesterday. The price of yesterday is the price of the day before yesterday. And those 3 falls happened in an uptrend. Let's define an uptrend as the close greater than a 200-day moving average, for example. That very pattern is going to be indicative that the price is going to go higher, okay? And if we go to the past, we're going to see that this pattern has happened at least 100 times in the past since the S&P 500 has been created, okay? That takes us to backtesting. My systems use historical data to backtest trading strategies to ensure that the patterns they recognize are statistically significant and have predictive power. These patterns are going to show me the past outcome every time the conditions are met. So if I know that every time that a pattern occurs, the S&P 500 is going to go up, what am I going to do? I'm going to buy, because I would be expecting the price to go up. So this is going to give me the predictive power to position myself in the outcome that the backtesting had shown me, okay? And it gives me adaptability. The most sophisticated systems can adapt to new patterns as markets evolve, using machine learning and other advanced techniques to improve their predictive capabilities. And emphasis of anticipating asset movements with a high success rate based on historical data. The trading systems I have use historical data to develop models that aim to predict future price movements. The success of these models depends on the quality, depth, and relevance of the data, okay? The quantitative analysis of these systems often use quantitative methods to determine the likelihood of future price movement, helping us to make informed trading decisions. These decisions are taken based on what had happened in the past, on how these patterns have behaved in the past, in order to have a determined range of probabilities that are going to indicate us where the price is heading to, okay? And by using historical data, we can anticipate the potential asset movements. So we can set a better risk management parameter, such as stop loss orders and position sizing to protect us against losses. If I can check the past and I can see how each of the patterns we are trading have behaved in the past, I can have a precise measure of what to expect. I can have a precise measure about how the price, the pattern could fail and I can prepare my system in order to face that anomaly in the behavior I'm trying to take advantage of. It's important to know that while automated trading systems can have a high success rate, they are not foolproof, okay? That's why we have to have these risk management measures in order to try to neutralize the fails in the patterns we are trying to exploit. Okay, how do we arrive to these patterns? By using statistical probability. And this takes us to the quantitative aspects of our trading methodology. Let's break down each point. When I speak about expectation, I speak about expected value. This is a fundamental concept in probability and statistics, and in the context of trading, refers to the average outcome of a trade or series of trades if the same strategy is applied repeatedly over time, okay? I don't know if you guys have heard about the law of the great numbers, but it refers to that very law, okay? What I'm going to expect is to transpolate what had happened in the past into the future, okay? Having in mind the expected value of each of the trades, considering the series of trades that I have found in the past, observing, of course, the pattern behavior of the past, okay? And in trading, the expected value helps determine the long-term profitability of a trading strategy. A positive expectation indicates a profitable strategy, while a negative expectation suggests a losing one. So in order to use a trading system in our portfolio, this trading system has to have, of course, a positive expectation. The expectation is calculated by taking the sum of all the possible outcomes, each weighted by the probability of its occurrence and its respective gain or loss, okay? And explaining how my trading system utilize historical data to predict potential gains and losses, my trading systems analyze historical price data to identify trends, patterns, and behaviors that have preceded gains or losses in the past. As I explained, for example, this pattern in the S&P 500. And by using historical data, the strategies are backtested to see how they would have performed in the past, which can give insights into the potential for, future performance. And each of the systems have used historical volatility and price changes to model the risk, that would be the potential loss, and reward, that would be the potential gain associated with different trading strategies. Okay? And this would take us to our system's adaptability to various market conditions. And regarding this, I have to mention the dynamic adjustment. Adaptive trading systems can adjust their algorithms based on changing market conditions, potentially improving the predictive accuracy. And by using, for example, machine learning and AI, many of my systems incorporate these algorithms that can learn from market changes and modify their strategies without explicit reprogramming. And this also allows us to have a stress testing. All the systems are often stress tested against extreme market scenarios to ensure that they can adapt and perform under various market conditions, including high volatility and atypical market events. So these points underscore the complex nature, of course, of algorithmic trading systems, which combine statistical analysis, historical data modeling, and adaptive mechanisms to create dynamic trading strategies. But the aim is not only to predict future market movements, but also to manage risk and adapt to new data as it becomes available. It's worth noting that while these systems can be highly sophisticated, they are not infallible and can be subject to the same uncertainties that affect all market prediction. That's why, again, we focus mainly on the risk management measures I had mentioned before. In conclusion, the various points I mentioned today relate to risk management strategies and the use of algorithmic trading systems to trade the portfolio you have seen in the championship. And the benefits of these approaches in trading and investments are an enhanced decision making with statistical analysis. The discussion of statistical concepts such as expectation helps us to quantify the potential outcomes and make more informed decisions by considering both the probability and the magnitude of possible gains and losses. An optimized use of historical data. By utilizing historical data, trading systems can predict potential gains and losses, allowing for a more empirical and data-driven approach to trading. Our method benefits our portfolio by reducing the reliance on speculative or heuristic decision-making and improve risk management. The application of risk management techniques like the ones I mentioned, diversification, stop losses orders, and long-short positions helps us to mitigate losses and enhance returns. Diversification across assets and markets reduces the impact of any single investment's performance on the overall portfolio. Stop loss orders cap potential losses, and long-short positions allow for profit opportunities in various market conditions. We also obtain a reduced emotional bias because the automated nature of our trading system approach helps us in eliminating emotional biases that can lead to irrational trading decisions. This contributes to a more stable and consistent investment strategy. It also gives us adaptability to market conditions. The adaptability of trading systems to various market conditions ensures that the strategies remain relevant and can adjust to changing market dynamics. This adaptability is crucial in managing risks and seeking returns in different market environments. It also gives us efficiency and consistency, which is one of the most important things I had looked for during the competition. Our algorithmic trading system can operate continuously and execute trades with high speed and precision, thus taking advantage of opportunities that might be too fleeting for human traders, okay? We get a strategic risk distribution by ensuring equivalent risk distribution among assets, our portfolio can align our exposure with our risk tolerance and investment goals, of course, potentially leading to a more resilient investment portfolio. And being a market agnostic portfolio, this approach allows us for capitalizing on opportunities irrespective of the general market conditions, which can be particularly beneficial in times of market stress or when traditional investment strategies struggle, for example. In conclusion, the collective benefits of using statistical analysis, algorithmic trading, and risk management strategies led us to a more sophisticated, efficient, and potentially profitable trading systems and portfolios. These systems aim to maximize gains, minimal losses, and maintain a level of performance consistency that might be challenging to achieve through manual trading alone. However, it's crucial to remember that no system, no portfolio is without risk. That's why we adopt those measures in order to monitor, evaluate, and adapt our portfolio to the different market conditions. This is essential to maintain the effectiveness of our strategies and our portfolios over time. Okay? So that was the way I won the World Cup during 2023, and now I'm open to all the questions you guys have. Chad? I don't hear you, Chad. Can you guys hear me? I don't hear you.
Sorry, how about now? Can you hear me now?
Yes, I can hear you now.
Okay, I'm so sorry about that, you guys. Ivan, thank you so much for the excellent presentation. We did get many questions during your presentation. I'll be able to combine some of them and ask you appropriately. First, if it's okay, I'm going to briefly go through the World Cup Advisor site, highlighting some of the tools that we offer for analysis, and that will answer some of the questions that did come in. So let me begin with this short presentation, then we can circle back, Ivan, if that's all right. So what we have here, I call the two pillars. It's really the World Cup business model is built on these two pillars. One being the World Cup Trading Championships, which we all know Ivan won the 2023 contest, and then WorldCupAdvisor.com, where we offer the auto trade trading service, where subscribers can automatically follow Ivan's current program, which is Emerge Funds, which we're going to discuss that in a little more detail here. So WorldCupAdvisor.com provides a trading solution for investors. We identify talented pros like Ivan and enable followers, or we call them subscribers, to mirror the live trading in their own personal account on a fully automated basis. The advisors have their own money on the line right along with all the followers. So Ivan's program, Emerge Funds, that we're going to go through, he's trading that program with his own account, his own funds. All of the advisors on WorldCupAdvisor.com do exactly that. Now, this diagram illustrates how the auto trade service works. All the advisors trade their own accounts with their own funds, and then the World Cup Advisor TradeSync software literally intercepts the advisor's orders and redeploys them to the market in block orders. So this process allows for average price fills for the advisor's accounts as well as all the followers simultaneously. So this provides for zero slippage. The followers get the same exact fill prices in their account that the advisor gets in their own account. Now, when you're entering a program that has open positions in it, for example, Ivan has a few on right now. If you were to enter today, you'd be entered into those positions as they are. So you on the first trades, you don't get the same exact fills, of course, unless your advisor is flat at the time that we enter you. So that would be the only exception to the rule. Once you're in the program, then moving forward, all of your fills are the same exact. This here is just a screenshot of the program's trade history section. Of course, you have access to this as a subscriber. You are able to see the open positions. So as a paying subscriber, you can view the positions moving with the market in real time if you want to. As I said, the service is completely automated and the execution is automatic. So you don't have to access this information, but it is there and it's available for you if you'd like to review it. This here's just a screenshot of Straits Financial daily statement. A lot of clients that have followed the World Cup programs don't necessarily log in and view the open positions or the orders like I just showed you. They're simply depending on their daily statement to keep themselves informed. So your level of involvement on a day-to-day basis is kind of up to you, how often you want to engage. I know we've got clients that look a lot, and of course we've got clients that don't look often at all. If you're considering following Ivan's program, here's his full bio page that's available on the World Cup Advisor website. I encourage you to look through all of the sections in the program that it offers. The next one's the specification section. This is going to answer a lot of questions that you may have or that you've already asked, like what would be the minimum to follow the Emerge Funds program that is listed here, 50,000. That's how much Ivan started the Emerge Funds program at the beginning of 24, offering that as the auto trade service to follow him. It's also going to answer questions like what markets does he trade? You could see there's quite a long list here, so it's a very diversified basket of markets that he had discussed. So he's looking at a lot of different markets for opportunities. So you can certainly go through this section, learn a lot more about the details of the Emerge Funds program. One that's important is the subscription fee. Each advisor charges a monthly fee to follow their program. In this case, it's $500 per month for the Emerge Funds program. That's a flat monthly fee. That's how the advisors make money on our business model. They do not participate in a percentage of the profits or a percentage of the commissions. They're simply working for the flat monthly fee. Want to mention that all the performance that you're looking at on World Cup Advisor is on the performance pages are net after all the costs and fees are deducted. So I know Ivan showed in his slide deck his drawdown section that is available in the performance report that you can access just with a free guest membership on the homepage at worldcupadvisor.com. Let's go through some of these questions together here, Ivan, if we can. Let's see, we only have about 6 minutes or so, so let's see what we can answer here. A lot of questions initially were about performance, so I just want to reiterate a few things on performance. You can access the standings page at worldcupchampionships.com. That's going to show the current standings of World Cup events. For Ivan's current program that we discussed today, Emerge Funds, you need to go to worldcupadvisor.com. You can get a free guest membership. to access the full performance report, as well as the trade-by-trade track record history that Ivan's done thus far. And if you decided to subscribe to it, you would be able to access his open positions and orders as well. We had several more questions regarding the drawdown. I know we highlighted that a bit in your portion of the presentation, Ivan. And in that section, it showed that your drawdown from last year was 2 months and the recovery period was 1 month. I know so far in emerge funds, we have not had a drawdown on a monthly basis yet. It's only been less than 2 months so far, but excellent start to the year. Here's a few, Ivan, that perhaps you can address regarding position sizing. And you and I have discussed this a bit in terms of your maximum margin requirement. If you can discuss that a bit, and then also your maximum percentage risk on each position. If you have a set amount or if you vary that based on the conditions, you can discuss that a bit, please.
Yeah, each of the stop losses are determined having in consideration the volatility of the market I'm trading. We don't have a nominal amount to determine the stop loss. Each of the stop loss is determined by volatility measures of the market. We try to, as we discussed when we created the program, we tried to not surpass more than 60% of the capital with merchant, because we want to have a matrix in terms of possible drawdown. What we wanna have is the possibility to experience a drawdown without reaching a margin call. Okay, that's why we try not to surpass 60% of the total capital for merchant requirements. That's regarding the merchant issue. Then, as I said in the presentation, we try to equalize risk among all the systems. During the program, I'm going to trade around 200 systems. Of course, not all at the same time. Each of them is going to be opening positions when the conditions of the patterns are met, but those systems are going to have an equalized risk between each other, because that's one of the goals we have. We want to contain the risk in order to not to concentrate all the risk in one very system. Okay, so we're not going to achieve a perfect equalization, but we try to have a similar equalization between all the open positions. How do we do that? By managing the size of each of the positions. If, for example, we have a position in crude oil, and let's talk about nominal so it can be more understandable, and this crude oil position has a risk of $5,000, and we have a signal of S&P 500, and this signal has trading system has a risk of $2,500. We're going to trade one contract of crude oil, and we're going to trade 2 contracts of S&P 500. Why? Because that would be the way to equalize the risk. Again, I'm mentioning nominals in order to clarify this, to make it clear, but we won't work with nominals. We won't have a fixed amount in order to determine the stop losses. We determine the stop losses in order to the volatility conditions of the market we are trading. Okay, when one trading system is activated, this trading system is going to evaluate the market conditions, the volatility of that market, and determine the position size in order to equalize the risk with all the other systems. That would be the answer.
Okay, thank you for that. Yeah, we have a lot of, let's call them detailed questions about your track record. Let me mention that with the free guest membership from the homepage at worldcupadvisor.com, you can access the trade-by-trade track record of Ivan's performance. In fact, you can download or upload all the data into Excel if you wanted to do some of your own analysis, or put it into your own software for your own analysis. I know you use proprietary software for execution and for your own analysis. We had several questions about what platform you use, what software you use, anything that you use for indicators. If you can discuss that, please, for a few.
We have a proprietary platform program in C++, and we also use Python in order to generate the orders. We route the orders into the platform assigned by the broker, and so we will route the orders that way. But we use a proprietary system. I've used a proprietary system to platform, pardon, sorry, in order to program to set my algorithms.
Okay, very good. Several people have asked about a recording. Yes, we are recording today. That should be available early next week for those that weren't able to log in at the beginning or would like to review anything. Also, a few questions about being European and being able to invest into emerge funds. Yes, absolutely. You can certainly do that. Please reach out to us. We'd be happy to guide you through the setup process for that. Also, I want to mention for US clients, if you'd like to use retirement funds, your IRA or Roth IRA, you're able to do that. We can assist you with that process as well. We did have a ton of questions. I'm sorry we weren't able to get to all of them. We did go over a few minutes. Sorry about that, Ivan. Thank you for sticking around and doing the full presentation with us. For all of you that still have questions that we weren't able to address in detail, or if you have some follow-ups, please reach out to myself. Let me put this up. You can contact me via phone or email. Be happy to help you with anything on the World Cup Trading Championships or worldcupadvisor.com and emerge funds and setting up your account to follow Ivan or perhaps compete yourself. Thank you everyone for joining us. I hope you join us again at the next webinar. Ivan, thank you again, sir. And
pleasure. Thank you.
Yeah.
Thank you all.
We'll be in touch soon. Take care, everybody.
Thank you. Take care, everybody. Bye-bye.